Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
We did get some economic data this morning. U.S. retail sales increased at a firm pace in the month of November, bolstered by a surge in car purchases and solid online shopping that masked more mixed spending elsewhere. This came from the U.S. Census Bureau. It said the value of retail purchases not adjusted for inflation increased 0.7% after upward revisions to the prior 2 months. And if you back out autos, sales climbed a more modest 0.2%, Tim, and that was for a second month.
Okay, separate data today showed U.S. industrial production unexpectedly declined for a third month in November on decreases in utility output and mining. Manufacturing output rose less than forecast. With more on the U.S. economic backdrop and what to expect from the Fed tomorrow, back with us is Stephen Skancke, Chief Economic Advisor at the wealth advisor Keel Point. Steve, also a former U.S. Treasury and White House National Security Council staff member, serving during the Nixon, Ford, Carter, and Reagan administrations. He joins us this afternoon from Washington, D.C. Steve, good as always to see you on the day before we hear from the Fed chair. This most recent data that Carol and I just mentioned, certainly something that the members of the Federal Reserve Board of Governors are looking at today. Is tomorrow certainly decided, the big picture of what comes in January, February, March? That's what has investors focused?
Well, first, thanks for inviting me on. It's always great to be with you. And answering your question, the markets certainly think that it's decided as to what they're going to do tomorrow. And when you look at all the things that they've said, I think it'd be a big surprise if they didn't cut tomorrow. They've basically indicated that, and the economic data has been supportive of that as well. I mean, the estimate for personal consumption expenditure, the core index, that's come down. That's really good news. The employment data was okay, but not overly strong. And what you just said about retail sales, very positive, even with gasoline sales down, and industrial production more tepid, which gives the Fed a little bit more latitude to be confident about not having to not cut rates tomorrow.
Well, and I guess, though, to that point, Steve, some would suggest, wait, why do we even need a rate cut? We've got growth in the United States. The economy still seems to be humming along. So why do we need it?
Well, the biggest concern, Carol, is in the employment side. You know, the unemployment rate ticked up a little bit. The Fed's projection is that it will go higher. We'll see what their summary of economic projections is for tomorrow in terms of the unemployment rate going into 2025. But that's where the Fed's principal concern is. They're okay with where inflation is, especially since it looks like it's starting to come down a little bit again. But they don't want to see job losses or a weak employment market get out ahead of them.
I also wonder how much of the concern, though, you know, again, maybe the argument for not cutting rates is that we still have inflationary pressures, and there are some concerns about policies, tax policies and other by President-elect Donald Trump that could essentially fuel some growth and also fuel some inflation.
Well, Carol, you're absolutely right about that. Interestingly, that's a little bit why I believe that the Fed would be reluctant not to cut when they announce tomorrow. They don't want to be seen as anticipating the economic result of some of the policies that President-elect Trump has announced. Mm-hmm. Obviously, tightening up the border, deporting folks, which will send wages up, create instability in the jobs market, and will also send up prices. Not only the one-time price hike from the tariff, but also the instability that is created in the supply chain, which then contributes to ongoing inflation.
Steve, the summary of economic projections, I know certainly investors will be focused on that tomorrow. What do you expect? Well,
I expect that the Fed is going to be pretty steady on that. they've been a little bit more, a little bit less optimistic along the way than we would have thought. But certainly for the unemployment number to trend toward 5% as we get into 2025, I think that's very realistic, even in the labor market that we have right now. And on inflation, I think they're just going to go. Their assumption is going to be as if there were no changes in economic policy going forward, and that's just part of the dance that they need to be in right now, so as not to be walking in or anticipating or trying to have any commentary about what the new Trump administration is likely to do.
Well, so should we take the summary of economic projections tomorrow with an even bigger grain of salt than we usually do, just because we don't know what the new administration will be able to implement in what timeline?
They're also slippery, right?
Yeah.
They can put them out there, and then they're out there, and then the next day something could happen, and they just don't apply anymore, right?
That's exactly right. And so yes, what they put out tomorrow is their thought about if nothing changed, where would we be?
Yeah.
And that's fair for what their job is. But in terms of practical application or actionable information, it's not particularly helpful, as you point out.
Hey, listen, one last question before you go. You guys, Keel Point's a wealth advisor. I am curious, since the election, as we get ready to wrap up the year, which plain vanilla old U.S. stocks have done just fine for a second year in a row, what are you hearing from your clients or the Keel Point clients? What's top of mind for them? Is it the new administration? Is it, I don't know, moving cash into equities? I don't know. What is it?
Well, there's a generally positive expectation for 2025. And the data support that as we look forward, absent some monumental or tectonic change. So that's a positive thing. But we certainly encourage clients to have available sooner rather than later the amount of cash they think that they're going to need to spend in 2025, so that if there is a correction, even if it's short-lived, that they're not in a position of having to sell assets when the prices are down.
All right, good to know, and always good to check in with you. Be well, happy holidays, Merry Christmas. Steve Skancke, Chief Economic Advisor at the Wealth Advisor Keel Point. Steve is a former U.S. Treasury and White House National Security Council staff member, and just giving us some insight on tomorrow's Fed meeting. And
looking past tomorrow, on Friday morning, we'll hear from Mary Daly, 7:30 a.m. Wall Street time of the San Francisco Federal Reserve. It'll be her first TV interview since the Fed meeting, so be sure to tune into that Friday morning, 7:30 Wall Street time on Bloomberg TV and radio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, the U.S., in case you hadn't noticed, is experiencing a surge in power demand, with electricity consumption expected to climb almost 16% over the next 5 years. Why, you may ask?
A few factors.
Right?
Is it because we're all getting EVs? I don't think so. Could have something to do with it. A few factors and drivers of that demand, including data centers, EVs, AI. Welcome, everybody, to the new economy. With more on what may be the next supply-demand imbalance are two killer members of our Bloomberg News team who reported out this story. They are Bloomberg News Power and Renewable Energy editor Will Wade. Also with Bloomberg News Energy and Climate Disasters reporter Josh Saul, both here in our Bloomberg Businessweek studio. Will, I want to start with you and get an idea for consumption and where it exactly is coming from. Is it all AI, or the push to move away from natural gas for heating and cooling? Is that part of it? Where is it coming from?
It's all of it, and it's all happening all of a sudden. So we've seen cloud computing. Everyone wants to put all your photos and your files up in the cloud. That's driving data centers, a lot of data centers. And then all of a sudden, the same big tech companies are starting to do AI, and that's an enormous use of power. So we've got data centers and then AI data centers, And then we've got the push to electrify everything. We want to use electric heating in your house instead of gas. We want to use electricity for your cars instead of gasoline. We've got factories that are trying to use electricity for industrial heat instead of gas or coal. So it's just coming from every direction. But the crazy thing is, we didn't really see this coming until about a year ago. So the utilities that build power plants, which takes years, weren't really planning for it that effectively. So now there's a potential looming shortage of electricity.
Which makes me wonder, should we just stop talking about the promise of AI and basically, because we're not going to have enough power to meet the demand, like should we just stop it already? Because the expectations, the euphoria is not going to be able to be met so easily or quickly?
You know what?
Because of the power demands?
I'm not so worried about running out of power, like you turn on the light switch and there's no electricity for the lights. What I'm worried about is people not working for clean energy. So we're going to see electricity from anywhere they can get it. We got people building more gas plants than we've seen in a long time. We got people that promised to shut down coal plants. Now they're going, let's keep those open a little longer.
Yeah.
Josh wrote about the gas plants a lot.
Well, tell us about that, Josh.
Right. So there's a concept I wanted to bring up because I want to get listeners familiar with it, and it's base load power. So the deal with wind and solar power is that it's intermittent, right? It's when the wind is blowing or when the sun is up, and it's very complicated to arrange a grid with a lot of clean energy sources because you have to balance the grid at all times. And when people wake up in the morning, they need the electricity running so they can run their appliances and get ready for their day. And sometimes if the sun isn't up at that point, that makes it tougher. What gas is really good at, a big gas power plant, is that it's base load power. It just produces pretty close to the same amount of power all the time. Gas also produces carbon, which makes it a climate issue, which is what Will's talking about. But we had the CEO of GE Vernova in recently, and he basically says, our wind sales are pretty flat, but our gas business is going bananas because they build the big gas turbines that power plants use to generate the power, and they've increased manufacturing, and they're selling huge amounts of these gas turbines because that's what data centers want. He told us, nobody's planning for anything other than 24/7 power usage.
Is there a way that we can offload, and by we I mean the United States, can offload some of this electricity usage, Josh, outside of the country where electricity is more abundant, in the sense, build some of these server farms in other places where there isn't an issue on the grid?
It's complicated and it's hard to do. I mean, with data centers, it's hard because some things that are operating on the data centers, certainly anything related to national security, and even lots of companies, they want their data in the U.S. Even in imagine the
nearshoring, onshoring is like certainly something that you see with the data centers. They want it nearby.
Yeah, I mean, imagine a healthcare company. They don't want all their data stored in some country that they don't necessarily trust. So you run into issues with that. And as far as moving other users of power, can't really move homes overseas without moving the family there. Obviously, that's complicated. And then a big factory, we want the big factory here because we want the jobs and we want the stuff produced here. So those power demands are also onshore.
There's so many things that are coming to mind. Remind us, guys, about the rules and regulations that are in place in terms of carbon emissions, that the kind of commitments that companies and individuals or institutions have to abide by under the current administration or under the current rules, and how a new administration might change some of that.
Okay, well, when Biden came into office, he said he wanted to have a 100% clean power grid by 2035, and they set a 2050 net zero target. But these aren't really binding. These were goals, and I'm seeing an increasing pessimism about reaching those goals.
And they don't even seem very close in the sense of years. Like, those are pretty far off.
Anyway, right?
Yeah.
But yeah, and we had so many companies, especially in like maybe the last 5 years, come out with their own internal net zero goals. And a lot of them were like really impressive and really ambitious. We're going to, utilities that promised to stop burning coal, big tech companies that said all of our operations are going to be carbon free.
Yeah, that was before ChatGPT.
That's the problem. So these things were not binding, and now we're seeing a lot of companies kind of going radio silent on their goals, or some of them are just straight out saying, yeah, we're not going to make that.
Does it matter if it's a global company? In other words, because it's got to deal by global rules and global regulations, or no? Not necessarily, in terms of hitting carbon emissions, reductions.
The utilities, so the power companies actually producing the power, they're here, so their goals are here. We're already seeing those get kind of a little eroded around the edges. Companies saying, well, we said we're going to be done with coal by 2030. We're actually going to be running these coal plants a little longer, but we're still sticking to our 2050 net zero goal. We're kind of seeing those eroded a little bit. But the way one energy analyst put it to me recently is he said, I mean, unless a company's goals are tied to some kind of state law, they're not really worth the paper they're written on, because they'll just keep getting eroded, and then as it gets closer to 2050, they'll get, maybe completely tossed out the window.
Hey, Will, what about nuclear? Where does nuclear come into this?
Which is something like, I feel like in the last 2 years, we all of a sudden hear everybody talking about nuclear energy.
Yeah, but I mean, you've spent a lot of time visiting nuclear facilities. Not so easy to just put a shovel in the ground and build one. No,
nuclear is great. I mean, Josh was talking about baseload power. You know what's even better for baseload? Nuclear. It runs like 97, 98, 99% of the time over the course of a year. You know what's not great about nuclear? It takes years to build. So we've got all of these companies. Seriously, in the last couple of months, a lot of the big tech companies have announced these really big deals to use nuclear power to power their data centers in 2030 something when they're built, because there aren't any extra nuclear power plants laying around, and it's going to take years to build them. And they're working with companies that are developing new technologies, so they hope they'll be ready in the next 5 years, but it's, there's always the chance they can get delayed. So in the meantime, there's going to be a lot of gas.
It's kind of ironic, right? The move to clean energy is kind of complicating this process, right? In terms of wanting, as you said, the electrification of so much, that it's making it difficult to kind of hit these targets. And I'm looking at, a headline from today: California reeling from extreme weather as the wildfire risks return. And they also talk about another atmospheric river up in Northern California. I mean, as we are talking about this, we continue to see it firsthand, and increasingly the impact of climate change. So I just wonder kind of where this all leads us.
Yeah, that's the right question. And the answer is we don't know. We are seeing climate disasters in real time. In the summer, it's too hot. Now in the fall and the winter, we're getting too much rain.
And wildfires like in New York City, which are like unheard of.
Yeah, make for great sunsets, but it smells bad. And we're seeing the climate really has been affected. And that's the right question to ask, because all these factories are trying to decarbonize, but then where do you get the electricity? The people that point out, oh, you think you're so green because you've got an EV, but you're powering it with coal power. So there's a lot that has to happen. It's not an easy switch.
Well, Josh, this is your beat. I mean, you're energy and climate disasters reporter. So what is the fundamental connection between these two things?
I see it that, of course, the factories that produce the things we need for clean energy require power, but anything that we produce requires power. So I think overall that transition is still good for decarbonization, is still good for putting less carbon into the atmosphere, and hopefully at least not accelerating those kinds of wildfires and those other things we're talking about. And I think that's more important than...
Yeah, well, okay, so Will, come on in here, because you mentioned the grid, and this is something that we haven't spent a lot of time talking about, the health of the grid. And it's sort of this patchwork, at least here in the United States, where, you have... Texas always comes to mind, for example, given the freeze that they saw a few years ago and the failure of the grid. Where does the stability of the grid come into the conversation?
That's another huge issue. Lots of the grid is not so stable. A lot of the wires have been standing there for years, and when a hurricane comes through, they get knocked down. The utilities say they want to underground the wires because it's more reliable, which is a great idea, but expensive. You use the word patchwork. I think that's a pretty good word, especially because it's multiple systems operated by so many different companies in so many different jurisdictions with different rules. It's complicated.
Well, we know it's like not easy. Josh, I also do wonder, is there something else within the alt energy space or new energy space that we're not talking about? My husband constantly is like, what about hydrogen fuel cells? Like, that makes sense to me. Like, I'm just curious, is there something that, I don't know whether it's in the next year or next 6 months or next 2 years that we start talking about that might help this situation? And just got about 25 seconds.
I think a lot of those things, fusion, hydrogen, a lot of those things are pretty far off. I think right now it kind of is just back to the basics. That wind and solar takes some pressure off the grid.
Yeah.
And but yeah, right now it just looks like the next year looks like just more gas.
I want to say, are you guys optimistic? No.
But you'll be busy.
No, at Thanksgiving, my
Lots to
family
write
asks
about.
me, "It's like, what about this climate thing? Are we going to solve it?" I'm like, I hope so, but I'm not optimistic.
You're just there with the bad news.
It gets worrisome. Hey,
Yeah.
guys, you keep us, though, up to speed. Thank you both so much. Will Wade, Power and Renewable Energy Editor, and, of course, Josh Saul, Energy and Climate Disasters Reporter here at Bloomberg News.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
It is time for another edition of Bloomberg Plugged-In, your weekly look at EVs. And Carol, as always, no shortage of goings-on when it comes to the world of EVs.
So much going on.
You pointed out this story to me earlier today. You were like, did you see this?
I'm kind of blown away by this.
Honda and Nissan are preparing to start negotiations on a possible merger, which could ultimately be expanded to include Mitsubishi Motors. This is according to a report from the Nikkei in Japan. Merger designed to help the companies compete against rivals in EVs, such as Tesla and Chinese automakers.
Listen, I think about this, right? What kind of consolidation might have to happen in order for all of these auto companies to be competitive? We also do want to point out that Peter Navarro, who is set to become the top trade advisor to President-elect Donald Trump, saying earlier today on CNBC that policies that have been favorable to the EV space may not be around during a second Trump White House.
And then on the demand pull side, what we have is, first of all, those green mandates, that EV mandate, that is gone. That's gone like the wind. That's going to help mute prices, the price level.
That, of course, is Peter Navarro earlier on CNBC. That was earlier today on CNBC. Just a reminder, President Biden has put into place policies that support the electric vehicle space and has called for reductions in carbon emissions. So that is some of what the President-elect Donald Trump calls the Biden EV mandate.
Patrick Sullivan is CEO at EV Realty. He watches this stuff closely. He's back with us from San Francisco. A reminder, EV Realty has 7,000 EV chargers installed. It's built 70 supercharger hubs. The focus is on powering commercial fleets. Patrick, good to have you back with us. Remind everybody where exactly you play when it comes to the EV ecosystem, and specifically what types of trucks you're hoping are electrified.
Sure. Well, Carol and Tim, it's nice to be back. It's been really quiet on the Western Front for EVs since we spoke in March, so I'm surprised to be here. Tim, just I appreciate the flattery. Members of my team have built 70 superchargers. Superchargers are Tesla's product. So I would love to say that I built 70 supercharging hubs, but
you wouldn't be here right now. You'd be out in the field, I'm sure.
But just as a reminder for what EV Realty is focused on, we build large-scale EV charging hubs, principally for commercial fleets. So fleets operating medium and heavy-duty electric trucks. Our approach, and it's really been consistent from the start, is to find places on the grid that have all the power that those large fleets need to secure the power, to secure those pieces of property, and then to develop them into these logistics hubs.
Who has the fleets?
And principally,
well, remind us who has the fleets right now, because here in New York, you see a lot of the Amazon Rivian vans. You can see it on the screen right now. Perfect timing. Driving around. Is that a customer of yours?
They are, as are the larger trucks. And so here in California, where my company is based, a lot of the heavier duty trucks that are transitioning first are what's referred to as drayage trucks. So these are trucks picking up a container from one of the many seaborne or rail ports in the state, taking them to warehouses. Our hubs also charge sort of last mile delivery vans and vehicles that are going out to a home or a place of business for delivery.
If
but
people haven't seen
a lot
these,
of the,
I just want to jump in. I'm sorry to keep interrupting, but I have so many questions, and I'm not going to get them all because I know Carol has a lot of questions too. Who manufactures some of these trucks? If we haven't seen them out on the road, who makes these?
So you're starting to really see them out on the road. Here in California, there's over 1,500 medium and heavy duty, Class 7 and Class 8 electric trucks operating. Some of the biggest manufacturers for those vehicles are companies like Volvo, Daimler, International, PACCAR. These are the companies that also manufacture the vast majority. I think those four in particular are over 80% of the market share for Class 8 trucks. And so these are long-term established companies that are also now delivering EV trucks into the market.
Patrick, I got to say, I've been listening to you. You sound rather subdued. Tell me what your outlook is on the EV world. I think we're all trying to assess what a new administration means. Joe Biden and his administration have certainly put initiatives in place, including capital and spending, infrastructure that is very supportive of the EV world. But how are you looking at a new administration and what that might mean for this space and for you specifically in your company?
Sure. So elections have consequences, both sort of for individuals as well as companies and industries. And I think that certainly the change in the administration is going to affect the conversation around EVs. We're seeing it already. I think the reality, guys, is that we're well past the sort of the tipping point for EVs generally, but really thinking about the larger scale commercial trucks that do the work that move sort of the freights movement. And so my philosophy, certainly sitting here in California, 40% of the seabound freight, containerized freight into the United States comes through the Port of LA and Long Beach. That's almost 20 million TEUs a year. Half of that is consumed here in the state of California. There's a whole lot of focus on sort of cleaning up and making that supply chain more efficient. That doesn't just mean electric trucks. That means more efficient sort of logistics and routing and timing through a port. But there's a whole lot of really important work that is well on its way, certainly here in California and frankly, across the country. It's just not politically in vogue to talk about it too much right now.
All right. So still upbeat, just real quickly. You're still okay, positive, at least for the commercial
I am,
space.
yeah. Look, do I think that this is certainly going to have consequences? Absolutely. I think the broader question, and it sounds like you guys have covered this even earlier today in some of the pieces, the implications to ceding leadership in EVs generally for the U.S., that's what's consequential. We currently have the largest EV manufacturing company on the planet here in the U.S. Why stop now? We invented mass production of the vehicle 116 years ago. I think it's pretty telling when the CEO of Ford Motor Company didn't want to give back the EV that he's been driving for the last 6 months, the Chinese EV that he has been driving for the last 6 months, because it was a fundamentally superior product, and they're going to eat our lunch.
Patrick, so I do think, it's interesting listening to you. As you said, we've been covering this. We've been thinking about alternative energy, what it means under a new administration, combat change, goals, and so on and so forth. But it does sound like from what you're saying, there's almost a separation in terms of the commercial space, which has already made its commitments and its spending, and it's going to kind of keep going when it comes to probably alt energy and EV vehicles, versus maybe what we're seeing on the consumer side of things. Is that fair? Help me out in terms of, kind of from your vantage point.
Well, I think it's both. I think really the consumer side, certainly the impact of losing the EV tax credit will be felt, but again, keep in mind, over 1/4 of all new vehicles sold over the first 3 quarters of the year in California have been EV. It's about 9% nationwide. It's 25% in China. It's approaching 15% in Europe. I think you're going to see that continue, and frankly, those vehicles make sense economically today. On the trucking side, I think what is going to change, and really has been my company's focus from the start, you can't convince a commodity business to switch to EVs if the trucks are way too expensive and all of a sudden moving goods becomes more expensive. And so this transition really has to be economic. It has to make sense for the companies. It has to make sense for the shippers who are paying the freight rates. It can't be done sort of as a subsidy or just because it's green. And that's where I see, I mean, there are freight transport companies here in California moving goods that they win on brokerage markets profitably using EV trucks. That's really positive when you think about sort of signs for this industry growing.
How do you make sense, Patrick, of Donald Trump's stance on EVs and what we've heard from members of the incoming administration, given that Elon Musk is so close to him right now?
Well, as you said at the start, if I had built 70 supercharger stations, I probably wouldn't have been in this side of the conversation. So far be it from me to read into that. Look, I think at the end of the day, I think that rational, sort of clear-headed thinkers are going to make smart business decisions, whether it's around light-duty EVs, all of the manufacturing that's been deployed. I think there's over $100 billion of EV battery factories under construction right now in places like Georgia and South Carolina and Indiana and Kansas and Ohio. I suspect those are going to be really important considerations for the administration. And certainly, Mr. Musk is building a couple $1 billion factory here in Sparks, Nevada to deliver the Tesla Semi, which, if he does move forward with that, will be another category killer. And I have to imagine that's part of his calculus as well.
So, I mean, in terms of how you see it, Patrick, his relationship, his having the ear of the president-elect, Elon Musk, that is, of Donald Trump, at least for the moment, appears to be maybe a positive thing for the EV industry overall?
I'd like to think so. I think obviously Elon has a number of different and really interesting business interests beyond now just Tesla. But Tesla is what allows all those interests to grow. And certainly with the technology that he's pioneered, like the largest car company in the world, at least for right now, is Tesla. That would seem to be a perch that you'd want to leverage, not waste.
All right, we're going to leave it there. Patrick, thank you so much. Patrick Sullivan, CEO of EV Realty.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, TikTok, everybody. About 10 minutes left in today's trading session. Shortly, we're going to head over to our TV colleagues, counting you down to the close on this Tuesday, December 17th. Just want to point out that stocks, a little bit of a move to the upside in the last, 10, 15 minutes. We're still right across the board here on those major equity averages, but seems like a little bit of buying here into the close.
Yeah. The Dow, though, down for its longest losing streak, going back to 1978.
Yeah. I don't know. Does that
Shrug?
mean something?
Does it mean,
I don't know. I think all bets off until we hear from the Fed, see what they have to say. And then, I don't know, I think we have to get into the new year and find out more about policies. Let's see what our next guest has to say. Amy Magnotta, she's Co-Chief Investment Officer of Ategenos Capital. Ategenos?
It's all Greek to me.
I think I said it wrong. Say it for us. Tim and I have been going back and forth. Ategenos. Thank you so much. It's been a little bit of a crazy day. Good to have you here with us. There is a lot going on. There's a lot of speculation about 2025. With confidence, what do you say about the current market environment? And then do you feel like you have visibility of kind of where we go in 2025 yet?
I think we have a little bit of visibility over the near term. I think as we get into the first quarter of 2025, it's a little more unclear, I guess I would say. So we're pretty positive on equities for the short term here. I think from a market seasonality perspective, it's a good backdrop for equities into the year end and then also through January. But I think as we hit January, and we believe the Fed, will cut here, and I think it's to be determined next year whether we'll get the full rate cuts that we had anticipated. But and I think you just mentioned it too, just policy uncertainty as we hit into the new year. So there's been a lot of, let's say, optimism on the administration and what could come. From maybe deregulation, a pickup in investments, deal activity, things like that. But we need to see some some follow through on that. There'll certainly be some uncertainty as we start debating the extension of the tax cuts that will have to be dealt with at some point in the year. So I think we're positive in the short term, but a little more concerned as we look a little bit further out into 2025.
Amy, Carol brought my attention to a fund manager survey from Bank of America that says that fund managers have been reducing cash holdings to a record low, pouring money into U.S. stocks, and that's triggering a metric that Bank of America says may be a signal to sell equities. So this contrarian thing that's kind of happening right now. Do you see that?
We do as well. So that's one of we look at a number of market indicators here at Ategenos. We call it our signal. One of the signal factors that's flashing a little bit red for us is investor sentiment. And to your point on that report, we're seeing massive flows into equity ETFs. And when you look at investor survey data as well, the number of bulls are increasing. So that is a bit of a red flag for us. I do think that market seasonality outweighs that in the short term, as I mentioned, maybe through January. But that is a concern for us as we get into midway through the first quarter. And will the market be able to live up to expectations?
Amy, I do wonder, is there kind of a mentality out there among investors or even strategists, and maybe for good reason why, that U.S. still kind of the best market in town if you look around the globe, because there is still growth. We're getting inflation, it seems like, certainly way down from where it was a year ago, but growth is a big thing, right? A big factor. That's going to support corporate earnings growth. I wonder if that's a big part of investor thinking, and with good reason, and strategist thinking, and with good reason.
And that's our positioning as well. I mean, we've been favoring the U.S. all throughout 2024, and even we just shifted some allocations in our portfolio in November post-election, and actually further went underweight U.S. International equity relative to the U.S. And I think to your point, relative growth prospects are better in the U.S. It's a little more clarity. I think there's a lot of political uncertainty elsewhere as well. I think the administration is going to be a little bit more pro-U.S. dollar, and so that leads us to be more focused on U.S. over international.
What are some specific sectors that you're optimistic about?
We don't have currently any sector biases. I will say we like small cap U.S. stocks right now, so that's one of our larger tilts in our portfolio. So we think small cap attractive valuations relative to U.S. or relative to large cap equities, relative to their own history. Small cap companies tend to be more U.S. focused. So going to the same point about favoring U.S. over international equities. Also, lower rates should benefit small caps. So we like small caps. We like active managers in that space. And then we have a couple of thematic exposures that we have in our portfolio today. I mentioned not really liking international equities. Of international, we kind of view Japan as kind of the best house in a bad neighborhood there. So we do like Japan. Infrastructure in the U.S. is a theme. And then we recently introduced a new theme into our portfolio, is uranium. It's a small position. We look to build it over time, but we think that's an attractive opportunity for investors as we need increased demand for nuclear energy, not only just from broad energy demand, but also the data center growth for AI technology needs additional power, and nuclear can provide that. And we've seen a number of large tech companies come out and talk about their plans to add to power some of these data centers.
You must have been listening.
Yeah, we spent a lot of time talking about this, not just today. But over the last few months. It's pretty remarkable.
I do think, right? I wonder, in terms of investment plays, I think, okay, that's going to be a big one of 2025.
Yeah, there's the energy and the energy infrastructure plays.
Yeah.
We'll see. I mean, there's also the bets that on these SMRs, these small modular reactors that, have not come to fruition at this point. They haven't been built, but.
Amy, but does it take a while for that to, I understand why people are getting excited about nuclear power and so on to power all of the AI-driven demand. But having said that, 30 seconds left here, is it kind of earlier in the game to make that investment play? Or if you make a bet, you better be patient?
I think the latter. So I think we're a little bit early. It is going to take time for this to play out. It's expensive. But I do think you want to be a little bit ahead of it. But that's why we'll look to build it over time and be in positions that are, I would say, more diversified. So you get exposure not only to the uranium miners, but also those small modular reactors and other components of the theme.
Amy, so appreciate checking in with you. Amy Magnotta, she's co-chief investment officer at Ategenos Capital, joining us from Pennsylvania on this Tuesday.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.